seeking alpha. Let's take a closer look.
In 2017, the securities regulator charged 27 people for paying writers to publish fake independent analysis on a financial platform. The articles looked like genuine research. The platform cooperated. It was not charged. Then it charged a subscriber over $500 instead of a trial price of roughly $5. Another was charged the same. A third cancelled in February and was charged $239 in September anyway. 7 months after confirmed cancellation, the platform has a quantitative rating system, backtesting at 139% cumulative versus the index. Over 7,000 registered authors. It has never been regulated as an investment advisor. More documented billing complaints than any other platform in this series. The best research infrastructure and the worst billing practices in the same subscription. The founder worked as a technology equity analyst at a major investment bank during the dot-com bubble. He saw the structural failures of institutional research from the inside. Analysts paid by banking relationships, research that served banking clients, not the retail investors who read it. Conflicts of interest that were systematic and largely undisclosed. In 2004, he built a platform where investors and analysts could publish original financial analysis. Contributors ranged from professional fund managers to retail investors with deep sector expertise. The model democratized access to analysis that previously required expensive institutional subscriptions. By 2026, over 7,000 authors were registered with roughly 2,500 actively contributing. Total author payments run roughly $270,000 a month. The platform acquired a financial data company in 2019, adding quantitative infrastructure to the crowdsourced content. The platform structured itself as a publisher rather than an investment advisor. Publishers that provide general financial commentary are exempt from advisor registration requirements as long as they do not provide personalized advice. A 2024 court ruling confirmed the exemption. This means the platform has no fiduciary obligation to subscribers, no suitability requirements, no regulatory examination of its investment content. The distinction matters because what subscribers receive is general commentary, not personalized advice with a duty of care attached. The quantitative rating system evaluates stocks across 5 factors: valuation, growth, profitability, momentum, and earnings estimate revisions. A strong buy requires the highest grades across all 5, with no failing scores in any category. The system evaluates over 100 metrics and updates daily. In 2024, the strong buy ratings returned roughly 37% versus the index's 25%. In 2022, they returned roughly -1% versus the index's -18%, a significant defensive outperformance. Independent analysis broadly confirms a general edge. The community describes it as a useful screening filter rather than a standalone buy signal. But the billing practices that fund the platform are where the documented problems concentrate. The billing complaints follow a specific pattern that is more acute than any competitor in this series. A subscriber signed up for a trial of roughly $5 and was charged roughly $500 when the trial ended. 100 times the trial price. The platform cited fine print. Another subscriber was charged over $500 instead of the trial amount through a hurried phone process. Seeking Alpha denied the refund. A third cancelled in February 2025 and was charged $239 in September, 7 months after confirmed cancellation. The subscriber planned a chargeback through their credit card. A fourth paid roughly $5 for a trial and received a $270 charge the following year, considering small claims court. A fifth was charged for an annual subscription, attempted to cancel the same day the charge appeared, and was refused cancellation and refund. The pricing has increased in each year, documented by the research. 200 in totals, 39 in 2023, 269 in 2024, 299 in 2026. Each increase affects auto-renewal subscribers who signed up at a lower rate and may not have received adequate notice. The refund policy offers no refund on the standard subscription tier. Only the premium bundle and professional trial include a 30-day window. The Federal Trade Regulator's 2024 rules require that cancellations be as easy as sign-up. Complaints about cancellation difficulty and post-cancellation charges continued after those rules took effect. The platform also operates a marketplace where individual authors sell their own premium services directly to readers. Marketplace subscriptions range from roughly $50 to $500 a month per service, a subscription within a subscription. Marketplace billing complaints mirror the main platform's complaints, but the crowdsourced model that generates the content raises its own questions about quality and incentives. Over 7,000 authors are registered, roughly 2,500 are active. They are paid a base fee per article plus approximately a penny per view. The per-view compensation creates a documented incentive towards sensationalist, click-generating headlines. An article predicting a stock will multiply tenfold generates more views than a balanced assessment of fair value. The incentive structure does not require intentional misleading. It simply rewards prediction confidence and dramatic framing, which degrades the quality signal over time. The 2017 securities regulator case demonstrated what happens when the incentives are pushed further. 27 individuals were charged for paying writers to publish promotional articles disguised as independent analysis. The scheme targeted small-cap stocks. The platform cooperated and enhanced its disclosure requirements. Contributors must now disclose positions and any compensation from mentioned companies. Violations result in bans, but disclosure of a long position does not quantify the position size, the cost basis, or whether the author intends to sell during the window after publication. An author who discloses a long position and writes a bullish article may still benefit from the retail buying pressure their analysis generates. The institutional data business adds another dimension. The content, ratings, and subscriber behavior are licensed to institutional investors who use the crowdsourced sentiment data in quantitative models. Subscribers are simultaneously the customer and the product. Their collective analysis and trading patterns become data sold to hedge funds. The quantitative system itself has documented limitations. The momentum factor is backward-looking at market reversals. The growth bias creates a pro-cyclical tilt that underperforms in value rotations. When many investors use the same 5-factor model, the edge in those factors diminishes over time. The platform that democratized access to research also monetizes the community it built by selling the community's behavior to the institutions it originally positioned itself against. Seeking alpha premium is the best research infrastructure in this series. The quantitative rating system has the most granular backtested performance data in the comparison. The crowdsourced articles are genuinely better than average for deep sector analysis when the author has a disclosed position and a demonstrated track record. The breadth is unmatched. Millions of articles, transcripts, data, and ratings in one platform. The 2022 defensive performance and the 2024 outperformance demonstrate real value from the quantitative system. The platform cooperated with the 2017 securities investigation rather than obstructing it. But the billing complaint volume is the highest in this series. The trial to full price jump from roughly 5 to roughly 500 is the most aggressive pricing mechanic in the comparison. A charge 7 months after confirmed cancellation is potentially a systemic billing failure. 3 price increases in 3 years. Compound the impact on auto-renewal subscribers. The standard subscription has no refund policy. The per-view author compensation creates pressure towards sensationalism. And the subscriber base's collective behavior is licensed to institutional investors as data. At the current annual price, the data access per pound is strong. Compared to institutional alternatives, use a virtual credit card or prepaid card for any trial. Screenshot your cancellation confirmation. Monitor your statement after cancelling. The trial is a good way to evaluate the platform. It is not a good way to evaluate the platform if you forget to cancel in time. Every choice is a trade-off. At least now you know what you're trading.